Hi, I'm Steven Van Metre. Welcome to your weekly economic update. We talk macro, answer your questions, and do our best to try to make sense of markets. I know that really just don't make any sense, but we're going to give it a shot. I don't know that we'll get it, but we're going to try. So I've got a couple things I want to talk to you about from a macro standpoint. So the Fed announced today that they're going to taper their bond purchase program again. And normally this has two things that happen. Usually stocks drop on this news. They didn't today. And usually bonds drop too. Also, that didn't happen today. It's kind of weird. You would expect that the Fed tapering would cause the market to have an adverse reaction. Yet stocks continue to rise on the news. Of course, why they are rising, your guess is as good as mine. It's amazing that people can be as bullish in equities as the fundamentals of the economy are horrible. But yet people are so optimistic, at least when it comes to buying stocks. The bond market, on the other hand, rallied on the news, which is interesting. And as someone who owns bonds and is managing bonds for their clients, is this a concern for me? Not really at all. I mean, if you look at the numbers, the Fed's saying we're going to buy $10 trillion of U.S. Treasury securities per day and $8 billion of mortgage-backed securities per day, or a total of $360 billion per month. And keep in mind, at the peak of quantitative easing 1 through 3 following the great financial crisis, they bought a mere $60 billion a month. So why is the Fed doing this? Well, there's a shortage of treasuries in the global market. I know you're like, how can there be a shortage when we're literally borrowing $500 billion for this, $500 billion for that, and expected to run a $3.6 trillion deficit. Yet, there is a shortage of treasuries in the market because the banks need them, and they're getting cash. And so many people think the quantitative easing and the Fed's actions are inflationary. And I don't know if we talked about this, but sometimes it's good to repeat these concepts again, especially for those of you who are new, and thank you for joining us. When the Fed does quantitative easing, it exchanges a duration product, so a treasury security that has a maturity on average of 7 years, and they're trading it for an overnight demand deposit of cash. Well, banks don't want cash. I mean, they want cash to an extent, but it's hard to back a 30-year loan with cash. If you're going to back a 30-year mortgage, what do you want? A 30-year asset. Why do you think banks are all of a sudden halting lending? I heard they're cutting back credit. They're going to cut back credit card limits soon if they haven't started already. Why? Because they don't have the assets. They have the wrong assets to back this. They have cash. Well, what can you back with an overnight asset? Overnight loans. But what is the Fed trying to do? They're trying to lower short-term interest rates. That's the purpose of quantitative easing. That's exactly how it worked back in QE 1 through 3. For those of you who think that's inflationary, it's not. No new money is created. The Fed's just swapping one for another. There's literally no new money being created. So, well, where did the money come from to swap with the banks? Well, yes, they created that. But it's not. But that's sitting on the Fed's balance sheets. It's not in the economy. The banks aren't taking this cash and throwing it out the doors. No, the only way that money can get out is if the banks choose to lend it out and the consumers and businesses choose to borrow it, neither of which either side really wants to do right now. So as we go back to our macro thesis, we've been talking about, how to kind of build your macro view and some of the steps that I use. And I wanted to complete that thought today, and I intended to complete it on Wednesday, but I forgot. Is you have to, at some point, get to the foundation of what it is. What is your thesis? Now, my thesis is interest rates are going down. And I've held that view for quite some time. And it doesn't matter if you build your macro view from the, think of it as a building. You can build it from the top floor and go down. You can build it from the foundation and move up. It doesn't really matter. But at some point, you need a foundation to your view. Because otherwise, the building's not really based on anything strong. It'll fall over. Now, my view comes back to the Fed and secondarily now the coronavirus. See, I built my view. I've looked at the charts. I've looked at the economic data. I've done a lot of research. But the core part of my view comes from the lags of the Fed's monetary cycles, which says a massive amount of deflation is coming from when the Fed tightened. See, one thing that investors don't understand, we looked at on Wednesday's video, is there's approximately somewhere between an 18-month to 2-year lag from when the Fed actually either eases or tightens. Whenever they make a change in monetary policy, it takes that long for you and I to actually feel it. So all this Fed easing right now is not having an impact on the economy. I mean, do you see it? I don't. But it will in 2022. Believe it or not, that it will start to happen late 2021 on a small scale, but it won't be until early 2022 that we actually see this. So when the Fed tightens, it's extremely deflationary. Why is that? Because they are destroying dollars from the economy. They take those dollars sitting at the banks and they swap them with treasury securities. Now, the banks didn't really lend a considerably large amount of money out. So all they're doing is destroying dollars. Well, mostly it gets destroyed out of the global economy. And in a system of world dollar liquidity where foreign countries and foreign investors and foreign businesses need dollars and the Fed's destroying them, it hurts their ability to get them. And as a result, the economy has to shrink down to the whatever number of dollars is available in the global pool of dollars. The coronavirus has only further shrank that. Because what is the biggest tenet to making the world dollar liquidity cycle? Americans borrow money and go buy a foreign produced good or service. So if I go down to my bank and borrow money and buy a foreign car, I am putting dollars into the world dollar liquidity system. And if you look at the coronavirus right now, it's really killing global trade. And global trade was already in a bad place to begin with. In fact, it was really very weak historically. Now it's even worse. So world dollar liquidity is a problem. And that just supports my foundation of my thesis that we are going to see massive deflation. So that's how I come to the conclusion of my macro view that interest rates are headed down. Now, along the way, I need to look at the economic data to make sure I'm still on course, but I don't worry about the day-to-day fluctuations. I'm not worried, okay, so the stock market was up today. Big deal. It doesn't change my macro view at all. And last thing I want to mention from a bond perspective that you may not have heard is the Bank of Japan is meeting on Monday, and they are expected to announce an unlimited quantitative easing program. Woo-hoo-hoo-hoo-hoo. And I can't wait to see what that's all about, because the Bank of Japan, and you're going to love this. See, when you hear things, you have to really step back and think about it, not only just from a macro view, but from a world dollar liquidity view. You're going to love this. So the Bank of Japan said they're going to announce, or likely to announce, an unlimited QE program. Now, I'm hoping that this includes buying U.S. government Treasury securities. And you say, well, why would the Bank of Japan do that? Well, first of all, they have done it in the past. So it's not outside their realm to do it. So you're saying the Bank of Japan is going to issue yen and go out on the market and buy treasuries? Potentially. They have in the past. Well, why would they do it? Now, I want you to really think about this, because this is really where, when you get macro, you can see the movements of other players and how they're going to affect the system. So let's make ourselves in Japan. Why would I want to buy U.S. Treasury securities? Because what does the act of buying bonds do to interest rates? In case you need help, it causes them to go down. Now, if I am, let's just say I'm a large manufacturer of automobiles in Japan. Major export there. I don't know if it's their biggest one, but we know it's a large export. How do I get Americans, remember the key is Americans, to buy Japanese-built automobiles? Will I accomplish that if interest rates go up or down? Well, it'd be pretty logical. If interest rates went down, I don't know if they're going to buy a Japanese-produced car, but there's a potential they will. So what I need to do, or what Japan needs to do, is drive interest rates down And by lowering interest rates, what happens to used car prices? Well, believe it or not, they actually go up a bit, or they hold, I shouldn't say up per se, is they actually hold their value a lot stronger than they're anticipated. In the automobile business, when used car values are strong, people buy more new cars. And when interest rates are lower, and they get more for their trade-in than they were thinking, right? So let's say I lease a lot. I like leasing electric cars because I love electric cars. Number two, there's a lot of great leasing programs on them. And if I were to take my lease car in and it's worth more than I think based on my contract, I could be swayed to buy a new car or lease a new car. That's how the system works. So why would Japan want to buy U.S. Treasury securities? To lower interest rates, to get world dollar liquidity restarted, so Americans will buy foreign produced goods and services. Now, again, I don't know for a fact that they're going to do this, but man, if they do, that'd be great, because that means they're going to try to drive interest rates down. And of course, it just adds to the building I have built in my macro view of why interest rates are headed lower. All right, let's get to your questions. First one up, how will we know when the first peak is about to reverse and the time has come to take some profits so we can then re-enter for the run-up of the second peak? So the question is referring to bonds. So let's look at interest rates, because I don't know what this person is invested in. And for those of you who are new, I cannot give trading advice due to my licenses, so please do not ask for price targets, what securities to buy, what to do. You need to do that at your own level and your own risk. So let's look at 10-year Treasury yields, and let's go back to that first bottom in 2008 before we got to the second bottom later on that took 3 years later. And let's zoom in and zoom in again. And what do we find? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days where this was sitting at a bottom. So there were 10 trading days, or about 2.5 weeks, where you could exit. So what are you looking for? Whoa. Where did I go with that? Let's see here. What you're looking for is just a massive drop in interest rates, and you should get some validation from that, from the speculative position of hedge funds and whatnot that I mentioned in last week's video. So hopefully that helps you a bit. All right, next question. I also noticed today on April 22nd, 2020, the Fed increased the yield on the 30-year Treasuries. All right, so this is a massive misconception that I wanted to address. For those of you who do not understand, the Federal Reserve has zero control over long-term bond rates, interest rates. In fact, 30-year, 10-year, 7-year, 5-year, 3-year, they have no control. The Fed can only effectively control 3-month Treasury yields because it's the closest thing to the federal funds rate. They have no control over that. So the question was, I noticed the Fed did this. No, the Fed didn't do it. The market did this. And so the question goes on, in the market pumped. Is that normal that yields go up and stocks go down? Well, if that is the question, the answer is yes. Normally, when stocks go up, yields go down. That's the relationship. Now, does it mean on a day-to-day, hour-to-hour, minute-to-minute tick? No. It just means the general relationship is that is how they should move. Let's see. Let's go on with the question. The Fed makes an adjustment to the yield. They don't. They have no control of it. None. So does that pretend that the downside from 1.22, so he's referring, or this person is referring to the 30-year Treasury yields, to zero or negative, is it exponential? Well, it's a lot. I don't know if it's exactly exponential, but it does have a multiplying effect. What will it take to break through the 1.2% support? More buyers and sellers. And at the end of the day, that's always what it takes in the case of bonds. And what they're referring to is on 30-year yields. Let's zoom in. Here is roughly 1.2%. And today we closed beneath that. Now, what does it cause for yields to go down? It causes people, you need more people to buy bonds than sell them. And what do we know? Well, we know the speculative positioning, which we'll look at again on Monday from hedge funds and other speculators in the futures pit, is pretty deep. I mean, they're very, very, very short the long bond. The other side is we need buyers. Well, who's the biggest buyer in the market? That's the Fed, and they're buying a lot. So that's cool. So it's just a matter of time. This is something that just takes time to play out. Next question. Hello, Steven. Your videos are the best I've come across on YouTube. Man, that is very flattering because there's a lot of great videos on YouTube. Thank you very much. I appreciate that. Very kind of you to say. First, I've heard you say in a few videos that if the dollar goes above 103, some very bad things will happen. Can you elaborate? Yes, bad things will happen. So let's now, and this is what I do. So if I'm struggling with a concept, I just put myself in the position of someone who might be on the other side of this. Is who might need dollars? Well, let's say someone in the Middle East who produces oil. Okay, so there's a Middle East oil producer. They need dollars because they have let's say they took out a lot of dollar-denominated debt. So if I need $100 and I'm a Middle East oil producer and oil's $100 a barrel, all I have to do is go out and sell 1 barrel of oil. I get the $100 I need. Now, if oil is $50 a barrel, I have to sell 2. If it's 20 a barrel, I have to sell 5. So what if the dollar goes up in value? I have to sell more oil to get effectively the same number of dollars. And so what happens is, as the dollar rises, I have to flood the market with more and more oil just to cover my dollar-denominated debts. And what happens, it pushes commodity prices down and puts upward pressure on the dollar because there's this demand. And what the risk you have is when people are short dollars and they're all fighting to get them, it's like musical chairs. Eventually the music's going to stop. Someone's going to not have the dollars. And what does that mean? They're going to enter delinquency or default on their dollar-denominated debt. And that's a bad thing. And that starts to domino itself through the global economy. And that is why a rising dollar is dangerous. It drives commodity prices lower. And that begets even lower commodity prices. Because again, if I'm selling oil to get dollars and I just keep selling more. And what am I doing? I'm just flooding the market, driving prices down, chasing the dollar higher. So yes, a rising dollar is bad. And the other side is, it doesn't mean, let's just be very clear. I said a rising dollar. I didn't mean a strong dollar. I said a rising dollar. There's a big difference. The global economy wants a relatively strong dollar. They don't want is one that's rising out of control. So that is a big factor. And so yes, bad things will happen. It always does when the dollar gets out of control. And mind you, what the Fed is trying to do is weaken the dollar. In fact, let's go look at since we're speaking on the dollar, let's go look at a chart. And I meant to do this the other day. Where's dollar? Here it is. And let's zoom out a bit. And you'll notice the dollar's been in a strong topping pattern since 2015. I mean, this thing has just gone nowhere. It's tried to break 103. It tried to break it a second time. And let's zoom in a little bit. And despite all the Fed's massive amount of easing, despite all of its currency swaps it's put in place, the dollar is still sitting over 100 and it's coiling like a snake and it's looking like it's headed higher. And if it gets out of control at this level, which is quite interesting that the dollar could get out of control despite the Fed easing, means that the structural problems of the global economy are far worse than the Fed either knows or cares to admit. All right, so let's go back to the question and see what else is there for us here. Secondly, I agree with almost all of your sentiments. Well, that's pretty cool. And the more the market rises, the more I'm disbelief, as I also expect a leg down. Yes, I totally agree with that. I was wondering if you took into account enhanced unemployment benefits. Many people I know, myself included, are making more money than we did previously through unemployment. This is true. There is, and I think the income level is if you're $50,000 or less, you're making more. I could be wrong, but I think that's somewhere around the right number. The extra $600 a week is keeping a lot of people afloat. Yes, financially, correct. Emotionally, maybe not, but definitely financially. In my opinion, this could prevent negative crowd psychology until June. Yes, if you're one of those people where you have more income, it will, but that's certainly not, I don't think the majority. I think a lot of people don't. So let's go on. How do you think this affects the time of the second leg down? Thanks a lot. Keep up the great content. Well, you're very, very welcome. I don't think it really changes anything. Because one thing people aren't factoring is at some point they're going to call to go back to work. And their employer could say, hey, we want you to come back on this day. And they could say, well, I don't want to. Oh, cool, you're quitting? Because you got to think, as an employer, employers pay unemployment costs. So they don't want this to go on any longer than it has to. So the moment the state opens up and says, hey, you can bring these people back to work, they're going to call them and say, hey, time to come back to work. And someone saying, no, I'm not going to do that. I don't feel safe. For whatever reason, I want to see unemployment. Oh, so you quit. And so they're going to say this: you will report to work at this day at this time. If you're not there, we will accept your resignation. So people are going to show up to work. Now, do you think that we're going to have the same hours that we had before? No, employers are not going to have the same hours. They're not going to have the same demand. So what they're going to do is they're going to take whoever shows up and they're going to cut their hours. And then people are going to get mad. Well, wait a second, I can't live on this. Hey, and the employers say, that's not my problem. This is what I've got. It's a take or leave it. Well, then I'm going to quit. And the employer's going to smile and go, awesome. And whoever walks away, then the hours remaining will be divvied up. And what people are going to find out is when they quit, you don't get unemployment benefits anymore. So for the moment, I think people are feeling okay. My guess is that most of this money gets saved because of uncertainty. And the uncertainty is, I'm not going to be making the same wage I made before. So I don't think it really changes the demand structure. I mean, now if you told me that all these people that are getting these enhanced benefits are going to go back to their full wage and are dying to go out and spend that money, I could see some potential change of opinion. I'm going to bet that a lot of that money gets saved. That's just my hunch. We'll see how it plays out. All right, let's go on. Let's see. Hi, Steven. Enjoying the clips on YouTube and your commentary. Well, thank you very much. Very informative. Thank you. You're very welcome. Just wondering if you see it is the same way, but both Europe and USA are skipping socialism directly to communism because A, there's a set salary per month now. B, the government's buying all the stocks. Well, okay, they're not, neither Europe or the US. I know the US doesn't, and I have no evidence that the European Central Bank is buying stocks. And C, there'll probably be an announcement soon enough. Well, maybe. This is my guess, but I think it's gone from possible to probable. That housing will be free, but the government keeps ownership of the houses. Do you think this is an accurate look from this unheard of market activity? No, I don't. And I don't because the U.S. monetary system, I mean, mostly the global monetary system, if you're running a debt-based monetary system, you're not really set up for communism. It wouldn't work. I mean, that would imply that the government's going to hold all the debt, and the system doesn't work that way. So I don't think so. Maybe it's possible, but in my view, I don't think that's correct. But you never know. I mean, what politicians are thinking. But I think there have to be structural changes in the monetary system to make a shift like that. The system would probably collapse if we tried to. And so that's why I don't think that's what's going on. Hi, Steven. First of all, I just discovered your channel. Love your videos. Thanks. I had a question about today's video where some of these questions are all getting mentioned. The computer's driving up the recent rally and they would soon be running out of money. What data are you looking at to give you that impression? And would we be able to access the data as well? Thank you. Keep up the fantastic work. Well, you're very welcome. Glad to have you as part of the channel. The answer is, where do I get this information? Is sporadic. There's a website called zerohedge.com, and I will tell you, full disclosure, I do not read all their articles. There are certain content that I look for from certain people, and occasionally, and very occasionally, a Charlie McElliott of Nomura, in fact, I don't even know what the full name of the company is. They run some quant computers, and while he shares this data with his institutional clients, who you have to have money at Nomura, and personal accounts aren't going to cut it. You have to have a ton of money with them, and you have to be approved to be on the list, and then you can see kind of what they're doing. And every once in a while, he allows his stuff to be published on Zero Hedge. It is not consistent. I just happened to read something, prior to making that comment. And the other way I can look at it, if you go to trading volumes, so here's the S&P 500 largest ETF, SPY, and you can see trading volumes are falling. That's an indication that buyers are running out of money. Normally in market rallies, you want to see a market rally as volume rises. So as volume is falling, it tells you there's just less and less demand. And so that kind of would validate that. But unfortunately, not only do I not have access to that data because I am not a client of Nomura, but there's no way that probably you would either. And if you did, it's not something you could really trade on, even though some people, I believe, try to. Let's see how we're doing on, long time. Okay, so let's get on with the macro data, and then we'll come back to the questions later. I know I'm deeply behind on those, but hey, it is what it is. Let's take a look at the macro stuff, and with that, onto the banking data. So there's some really interesting stuff going on here. And you can see Treasury and agency securities rose. So the banks are back buying bonds Well, the Fed is backing off because the banks needed them. And notably, they're not buying mortgage-backed securities last week, but they did pick up some more Treasury securities, and they backed off a little bit on their agency securities. Looking at loans and leases, that was up only $10 billion. What's notable, of course, commercial industrial lending continues to skyrocket. But what shocked me was the decline in real estate loans. Now, what this tells me is dropped $7 billion. You can look at this in one of two ways. One, $7 billion is the weekly runoff in people making their mortgage payments because there's not a lot of new mortgages being originated. Or number two, this is the effect of mortgages going into delinquency outside of the kind of temporary forbearance that's being made by banks. So this is not good news. You do not want to see a decline in real estate lending. So you look at one hand, you're looking at this saying, well, loans and leases went up, but real estate lending went down. That's not good. The next level we look at is commercial real estate was flat, so that's not great. But look at consumer loans. Man, there's a big drop off in consumer loans by $19 billion. So that tells us there's something wrong with the consumer. And a lot of that's coming out of credit cards. So either people are going delinquent on their credit cards. I can't imagine they're paying them off. I mean, maybe it is, but I'm guessing, this is where it comes back to financially there. Yes, there's some people that are fine, but a lot of people aren't. And so we're not seeing a lot of demand from the consumer. And that tells me that the health of the economy is much worse than advertised. Let's take a look at the charts. So we see the M2 money supply is growing out of control due to Q eternity. No surprise there. A lot of this is coming from money flowing into institutional money market funds. The monetary base is up to 4.9 trillion. Now this is interesting because when we merge the two together by taking the monetary base and divide it by the money supply, we get the money multiplier, and it's down to 3.44. And what that tells you is banks can now lend 3.44 times against a deposit. Since banks are marginally they're not even lending one time against deposits. So what this in Steve's lingo is, when money enters the economy from a loan, it moves hands 3.44 times before it dies. And this is deflationary. So anyone telling you that there's inflation coming, this clearly tells you it's not. And this is weekly data. So this is as current as of last week. Looking at real estate loans, the growth rate is down to 4.68%. So low interest rates have not spurred this. I expect this number to continue to fall, despite the fact that commercial industrial lending is running at an outrageous pace as corporations borrow money to try to stay afloat. And not surprisingly, loans and leases at all commercial banks, the growth rate is now flattening out, even though you'd think it'd be rising due to just the gut-punching amount of commercial loans being originated. But residential loans are a big factor here too. So we're seeing this flatten out, mainly due to residential loans. But look at consumer loans. So you have credit card growth rate is down to I double-checked this, minus 2.13% from a year ago. So it tells you right now that all of that lending going on in the consumer space, which is normally bullish for the economy, is not. So you look at this and you say, hey, the consumer is in bad shape. And this is very, very unusual. I mean, we don't usually even see this kind of a drop during a recession. I mean, that's what makes it very, very interesting to me. All right, let's go back to some other stuff I want to look at that came out this week. So this is a chart that I worked on. In fact, I probably owe nearly all of the credit to Dr. Chris Dark. He's much better at charts than I am. And this was something, like I said, I want to say we worked on it together, but most of it I have to give credit to him. And kind of a side note, Dr. Chris Dark, if you want to follow him on Twitter, which I recommend I follow him, very smart guy, very well respected and liked on the financial subsector of Twitter. He also runs I don't know if it's weekly, but all I know is I'm delinquent on being on my own podcast listening and video watching. I've got a lot to catch up on, his included. And he just came out with a new one, and I think it's a bull and bear case, which are great. I listened to his gold one. Again, the guy's well respected, so check him out. If you're on Twitter, look up Dr. Chris Dark, and you can follow him. Highly recommend it, and you can find his podcasts are now on iTunes. Now, where they are, I don't know, but he posted a link to that. And if you're not on Twitter, here's what you do. You go to twitter.com, in the search box, put in Dr. Chris Dark. You can find him. So if you want another macro view and you like podcasts, give him an opportunity. I think you'll enjoy his content, and hopefully I'll get a chance to catch up with him soon. But anyways, what we, mostly he, came up with was, how do we take the durable goods new orders data and find the pulse of the consumer? So what this is this chart of new orders for consumer goods, excluding defense spending, because obviously you and I aren't going out and buying tanks and fighter jets, and subtracting transportation equipment, which is non-defense aircraft and parts, because again, we're not out buying Boeing airplanes either or servicing them. And so what this is showing is a minus 6.06% change from last year. So this is significant. Now, from a macro view, some people ask is, well, how do you know where things are kind of going? Well, because if you overlay treasury yields, and I'm kind of chuckling because this is a recurring theme of treasury yields tell you everything. So you can see 10-year treasury is falling. It was only inevitable the durable goods new orders were going to fall. Now, is the coronavirus magnifying that? Yes, but it was inevitable this was going to happen. And you can see there's a nice relationship between the two. You can go further and you can overlay commercial industrial lending. Normally there's a relationship as durable goods new orders rise. You would expect to see the commercial industrial lending data rise. And why would you expect that? Well, because if you are a producer and you get a bunch of orders and you don't have money to fill those orders, you go to the bank and borrow it. So right now we see this big surge in commercial industrial lending. At the same time, we see a big drop in durable goods new orders. And what is that telling us? That the surge in commercial lending is not due to economic demand. So sometimes in the macro world, you can't just take one thing at face value. You really have to kind of pull the lens back and say, okay, I see this as a drop here. What does it mean? Where does it come from? And it just tells us the consumer's in a bad place, but that shouldn't really be a surprise. All right, so let's take a quick look at some charts that I think are interesting, and then we'll catch up with some of this on Monday. So we kind of looked at the S&P 500, but let's go back. It broke through the 50-day moving average, which is moving averages can act like a level of resistance, and we saw it looking like resistance. I will not be surprised if this makes a second run back up here to this level of 28.72. So kind of expect that next week, although the bond market is not confirming it. So if you look at, say, 30-year yields, they're headed lower. Remember, you can only get deviations between stocks and yields for so long. I mean, they can run between themselves for a while, but eventually one will be right. And my view is that with the Fed buying and the banks buying and the deflationary effects of Fed tightening, or the lags from the lags of the Fed tightening that are deflationary, the coronavirus is deflationary, and maybe Monday the Bank of Japan buying treasuries. The bond market's going to be right on this, but don't be surprised if stocks try to push up to that level, but bonds are not confirming. They haven't confirmed any of this. And we can also look at emerging markets, and you can see emerging markets aren't really confirming the euphoria in U.S. stocks either. They're rolling over. Why do I like emerging markets? From a liquidity standpoint, they just really tell you where liquidity is rolling, and the exuberance in U.S. stocks is just not validated here. Let's take a look at TLT. Let's see, for the week, it closed higher, pushing through. Today was kind of interesting. You could see that it just did nothing, and then all of a sudden, late day, boom, 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 there it went, took off. And this has to be somewhere around the time the Fed announced they were cutting their bond purchase program, which in the past has led to lower bond prices. But today, the market thought, yes, that's higher. But what's key is it broke over this level of resistance. It's now been up there for a few days in a row. And this is really telling us that sellers need to come in here if they're going to suppress yield. Otherwise, we're kind of just very close to that edge of the bond market breaking up into that massive bull run with everybody short and the Fed buying and a lot of support behind it. So appreciate you taking the time to watch. I hope you find these videos very useful and worth your time to watch. We'll be back Monday. We'll see how the hedge funds are positioned. Got a ton more of your questions. And for those of you who are wondering, how do I submit a question? You can either email me or you can find me on Facebook or LinkedIn. But do keep in mind, I cannot give you trade advice, so any questions revolving that, I will not answer. They do generally come in on a first come, first served basis, unless I already happen to have a question about that I want to pair together, or something we just talked about that I think we need to clarify. So just so you know, I will get to them. I just can't promise you when. Anyways, I'm Steve Van Metre. Thanks for watching. Hope you have a great weekend, and we'll be back at you on Monday to see what's going on. Bye now. The content of this video is provided as educational information only, is not intended to provide investment or other advice. Materials not to be construed as recognition or solicitation to buy or sell any security, financial instrument, or to participate in a particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. The opinions expressed via that of my own do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.